Okay, I want you to just sit with this number for a second as we get started. 86 cents. That is exactly how much the price of silver moved on an average day this week. Just 86 cents. I mean, for a metal that has literally more than doubled in price since the start of this year, that's insane. Silver is notoriously the wild, twitchy, high-octane cousin of gold, right? But it just spent 5 straight trading sessions doing an almost flawless impression of a parked car. And gold, well, it did exactly the same thing. You know, most weeks, a quiet market is really just a boring market, but absolutely not this week. Welcome to today's explainer for Friday, May 22nd, 2026. Today, we're investigating what I'm calling the loudest quiet week of the year. We're going to unpack this central mystery, why the total absolute lack of price movement in gold and silver right now is actually the biggest and honestly, arguably the most bullish story in the entire market. As you'll see by the end of this explainer, you're going to look at this silence very, very differently. So here's our roadmap for today. We're going to start with the tape, then examine silver's suspicious quiet, track Iran, uranium, and oil, explore the macro tug-of-war, and finally, we'll reveal the floor beneath it all. Let's dive right in. Section 1. The tape. Let's unpack the weekly scoreboard. Look at the massive contrast between these two timeframes here. As I'm recording this, gold is changing hands at roughly $4,525 an ounce, so it's down a tiny 0.4% today, but it's holding that absolutely crucial psychological anchor of $4,500. Now, if you just glance at the headline on the left, you see gold is down 3.7% over the last month. You might be thinking, uh-oh, it's breaking down. But actually, scratch that. Zoom out to the reality on the right. Over the last 12 months, gold is up roughly 35%. You just can't confuse a short-term pullback with a breakdown. What we're really seeing is a massive long-term uptrend that's simply catching its breath. Moving on to Section 2, Silver Suspicious Quiet, Rest versus Rollover. Let's think back to that 86-cent average move I mentioned right at the top. July silver futures eased slightly from $77.01 to $76.11 early in New York trade, basically spending the whole week barely moving. And remember, this is despite being up well over 100% for the year. The crucial takeaway here is this: a quiet market is not a weak market. It's coiled strength. It's like a tightly compressed spring. Silver has run incredibly hard, sellers are leaning on it, pushing it, but the price just refuses to break. That points to durable consolidation. Now, granted, we do have to remember silver wears two hats. It's got heavy industrial ties to things like electronics and solar panels, meaning it's sensitive to global economic growth scares. But right now, defending those mid-70s looks like a market resting, for sure, not rolling over. Section 3. Iran, uranium, and oil. The global suspects. Okay, let's see how this all builds because it's like a giant puzzle. U.S.-Iran peace talks have totally stalled out because Iran's supreme leader reportedly ordered that enriched uranium has to remain on Iranian soil. So this creates this kind of slow-burn stalemate. Now, it's not a screaming panic that sends gold vertical overnight, but it definitely puts a steady, patient bid underneath it. But the geopolitical tension goes further than that. We're tracking a direct inflation chain here. Step 1, Iran is rebuilding its military capacity way faster than expected. Step 2, this tension pushes crude oil toward 4-year highs. And step 3, those high energy costs bleach straight into transportation, manufacturing, and food. Basically, it revives the exact inflation fears that the market was desperately trying to bury. And that leads us to the exact economic trap we might be walking right into: stagflation. It's sluggish economic output combined with sticky, rising prices. Believe me, it is a central banker's absolute worst nightmare. Think about it. If you cut rates to support sluggish growth, you just feed the inflation. If you raise rates to fight the inflation, you choke off the growth. It's a completely boxed-in environment. But historically, when policymakers are traps like this, hard assets like gold and silver become highly, highly attractive. Which brings us to Section 4. The macro tug-of-war. The Fed versus the dollar. So why isn't gold just ripping higher given all of that? Well, we have two massive opposing forces at play here. In gold's corner, we've got lower treasury yields with the 10-year note sitting around 4.57%. Since gold doesn't pay a yield, lower interest rates reduce the opportunity cost of holding it, which naturally lifts the price. But in the opposite corner, we have a very strong US dollar, with the index hovering near 99.1. A strong dollar makes gold more expensive for foreign buyers, pressing the price right back down. So gold is literally suspended in the middle of this macroeconomic tug-of-war. Softer yields lift it up, a firmer dollar presses it down, resulting in the flat, quiet taper seen today. Now, if you're sitting there waiting for the Fed to cut rates and light a fire under gold, well, here's a reality check. Rates have been held at 3.5% to 3.75% for 3 straight meetings. The committee is deeply, deeply divided with an 8-4 split in April. And get this, traders are actually pricing in a 37% chance that the Fed's next move is a hike, not a cut. No way, right? Add to that, Kevin Warsh is expected to take over as Fed chair by mid-June, which injects a massive dose of uncertainty. And we've got jobless claims ticking up to 211,000. So going into the thin liquidity of the May 25th Memorial Day closure, this data is absolutely critical to watch.
Section 5. The floor beneath it all. Central banks.
244 tons. That is the mastermind behind the market's incredible resilience right now. In just the first quarter of 2026 alone, the world's central banks, led heavily by Poland, purchased a massive net 244 tons of gold. This is completely price insensitive, patient money that literally doesn't care about a quiet week on the charts. To put a dollar figure on that physical weight, it equals a record sum of roughly $37 billion. And they are for sure not stopping. Goldman Sachs is projecting an additional 60 tons a month flowing into central bank vaults. That puts 2026 on track to reach an unbelievable 755 tons for the full year. This is creating a rock-solid, durable floor under the price that simply did not exist 10 years ago. And this is a long-term structural shift. It's not just a temporary blip. A staggering 68% of central banks say they plan to continue adding even more gold to their reserves. This is slow, massive accumulation that's happening totally regardless of the weekly geopolitical headlines. They are building a foundation. But hey, I want to keep us honest here because no market is ever a one-way street. Let's look at the mining sector for a second. The GDX mining ETF has seen outflows of $520 million in just the past month, and a massive $1.1 billion over the past 3 months. Why is that? Well, because cautious investors are demonstrating some healthy skepticism. They're taking some chips off the table, locking in their gains, and basically waiting for a clear, definitive catalyst before they commit fresh money. They see the quiet market, and they're choosing to just wait it out on the sidelines. So, heading into the long holiday weekend where trading liquidity is going to be incredibly thin, here is your bottom line watch list. Keep your eyes on 3 things for us. First, Iran. Any sudden news of a deal or a military escalation will instantly snap gold out of this tight range. Second, the dollar index. A decisive move up or down will finally settle that macroeconomic tug-of-war we talked about. And third, oil. If crude keeps climbing, it seriously amplifies the inflation threat, which makes hard assets much, much more attractive. All right, I want to leave you with this final provocative thought. Will you mistake silence for weakness? Or will you recognize a market that is simply waiting for its next catalyst? Do not mistake a quiet market for a finished one, guys. All the ingredients for the next major move, the geopolitical tension, the monetary trap, the massive central bank buying, they are all sitting right there on the table. The tape might be quiet right now, but the fundamentals, they are roaring. Thank you so much for joining me for this explainer. Enjoy your long weekend, and definitely keep your eyes on the data.